And for today's Bart Chart, is cheap oil causing a burger bubble? Yes, a burger bubble. Where are US consumers spending all the cash they're saving on cheap gasoline? That's a question, essentially, I want to ask today. Now, the answer could lie in this chart. This is the Standard & Poor's Supercomposite Restaurants Index. It's an index of 23 companies. You might be familiar with one or two of them. We're talking McDonald's here. We're talking Yum Brands with Jones KFC and Starbucks, to name but a few. Now, this index is essentially the home of burgers, of wings, of pizzas, of cheesecakes, and of frappuccinos. And right now, it's trading at an all-time high, going way back to January 1995. Year to date, it's up by 4%. From its low in October last year, it's jumped 17%. The best performing shares on Thursday, the 12th of February, were Wendy's, up 23% year to date, Sonic up 17% year to date, Papa John's up 13%. From 1985, the far left of your screen, it's risen more than 8 times its initial value of 100. By the way, the S&P 500 has risen a mere 4.5 times over the same period. But a very good question to ask is this: how cheap are these stocks? Well, the index is trading at 25.6 times reported earnings, about 25% above its average over the last decade. On a forward-looking basis, the stocks aren't looking cheap either. The index is trading at 23.6 times what analysts predict the companies will earn over the next 12 months. That's an all-time high and more than a quarter above its decade average. Very quickly, if you needed more evidence of the appetite for these types of company, for those burger companies, look no further than Shake Shack, the burger chain. It sold shares for the first time on January the 29th at $21. Shares more than doubled on their first day of trading. They're resting at $40.65. Burger, anyone?